show is sponsored by Fundstrat Research. If you are a self-directed investor looking for trusted insights to grow your wealth, check out Tom Lee's Fundstrat Research. When you sign up, you'll access his daily insights, market alerts, live webinars, and curated stock lists. Exclusively for listeners of Live from the Compound, Tom has provided a link for a 30-day free trial. Please visit fundstrat.com/Tom to claim your trial. That's fundstrat.com/Tom. You could also find the link in the description below. Outperformance starts with insight. Hey guys, it's your host, Downtown Josh Brown. Welcome back to Live from the Compound. We have a very special guest with us today. His name is Joe Davis. Joe is Vanguard's global chief economist and the global head of Vanguard's investment strategy group. Joe leads a team that is responsible for Vanguard's research and thought leadership agendas, as well as the development and oversight of the firm's investment methodologies and models. Joe, welcome to the show.
Oh, thanks for having me.
This is like, this has been a big glaring event on my calendar for weeks now. I've been so excited about it. I did spend the weekend reading your most recent paper, and we're going to talk about the book. But I just want to first start by congratulating you and everyone at Vanguard on the 50th anniversary of the firm, which you guys celebrated in May.
Yes.
Okay, and there was a big bell ringing, a big ceremony.
Oh, it's been really special.
Okay.
You know,
What does 50 years of Vanguard mean to you?
Well, I think it's really just a testament to investors.
Okay.
I think one of the beauties of Jack Bogle's philosophy, really, I think just long-term investment philosophy, was just what he would always say: stay the course. And what that means is that it's not that you don't care about market volatility, Josh, but you got to stay invested in the markets and let it compound. Just take its time and lower the cost of investing. So it's been truly wonderful. See, the entire industry has really embraced it. It's not just a Vanguard story.
Yeah.
And so that's where I think we're celebrating 50 years of lowering the cost of investing, which means investors get to keep more of their hard-earned dollars.
The first 35 years were the hardest.
Oh, my.
Because Vanguard was really out in the wilderness. It was kind of like you guys were running beautifully, but the zeitgeist was very much active investing for all of that time.
Yeah.
And then a switch flipped and it became the Vanguard era. We're very much still living in the Vanguard era now.
And I remember like being there. I don't remember the day, Josh, but I remember I started working at Vanguard early 2000s, and it was right. And I knew I had the privilege of knowing Jack. And he would famously say, you get what you don't pay for, which a lot of things in life, that doesn't seem to be intuitive, but, quality, all those sorts of things you associate with cost. But it's just really having driven down the cost of investment. It's just been phenomenal. And to see that, because ultimately it's not Vanguard's money. It's the end investor's money. It's just been a privilege to be a part of it.
Okay. Well, you guys have done an incredible job. And today we're going to talk about your new paper and your new book. We'll start with the paper because I spent the day on this yesterday in preparation, and I really love the way that you framed what I don't want to say battle, but what the central conflict of the next 5 to 10 years in terms of the economy is going to be. Will it be the AI decade where we will offset the population issues that we have, the demographic issues that we have, and we'll find a huge productivity boost because AI, in your estimation, is a GPT, a general purpose technology revolution, akin to the internet or electricity.
Yeah.
That's one outcome.
It's one path.
The other outcome is debt and deficits will unfortunately have a bigger impact than the impact of AI. Yeah. And you have that as your second highest probability for how things play out. Yeah. Give us the background on the way you think about megatrends and the way that you think about the four most important drivers of the economy and investing.
Well, again, where I started with all this, Josh, as you can imagine my role, you get a lot of good questions from investors. It's not just what the Fed's going to do if the stock market, say the next 6 months. It's actually very poignant questions. I mean, you'll get it from clients. You have it on. You talk about it on the show here. Like, are we deglobalizing? Which means, are we in a higher inflation world? Is the bond market ever going to care about the high levels of debt we have?
Right.
And is AI overrated? Is it underhyped? What are
These are the questions people come to you with on a regular basis.
These are the questions all the time. And then and again, there's a lot of, in my profession, respectfully, there's a lot of narratives being told. Yeah. But if I'm an investor, tell me, what are the probability and odds of some of these outcomes? Because if we can start talking about that, we can start talking about risk management, maybe modest portfolio diversification. And so I didn't have good answers to the questions from clients.
Right.
And so we tried to provide, create a data-driven framework. It is a model, so it's got limitations by definition. But I'm proud of the fact that we're starting to quantify these outcomes. And that, to my surprise, was the eye-opening finding. I cannot generate the consensus view that most have on the U.S. economy over the next 5 or 10 years. It is very unlikely we're going to have stable growth and stable inflation. I'm not here spinning narratives, Josh. It's coming out of this push and pull between the deficits you mentioned on the fiscal side, which can be negative, and then the promise of AI, which can be disruptive, but can also power on growth. We're going to get one of the two. We're not going to get the consensus.
So the framework that you use, the megatrends, these are, and we'll put these charts up ultimately, but you're saying since 1890, megatrends have been a powerful driver of changes in the most important four aspects of the market. What are those things? Earnings yield?
Yeah, earnings yield. So it's on the stock market, the real driver. It's interest rates.
Is it earnings yield is a stand-in for valuation and profitability?
Yeah, it's a stand-in for profitability, valuation.
Okay, so that's one.
It's the inverse of
what's number two?
10-year treasury yield.
Okay, what's number three?
Inflation.
And then interest rates?
Yeah, just growth. Well, the 10-year treasury yield, the interest rates.
Okay, so then economic growth.
Yeah, economic growth.
You specifically say real economic growth, meaning inflation adjusted.
Yeah, inflation adjusted.
What are those four things to you for the investor?
Well, again, stocks and bond, they're the catalyst for stock and bond returns.
Okay, right? So that's the drivers of return.
Drivers of return for most portfolios.
Okay. When you think about those four things, one of the things that you do in your paper, your team does in your paper, is you try to get at to what extent are each of those driving the returns in the market over time. Yeah. And they're not necessarily constant.
No, they're moving all the time.
They're moving all the time. That's what makes it so hard to forecast stock returns.
Totally.
Because you don't know which of these things is going to be the driving force for the next 6 months.
Well, the big eye-opener for me, Josh, is that everyone, even central banks, the Federal Reserve, they do this all the time. They're at press conferences and they talk about all the demand. They got to raise interest rates or cut interest rates because demand is weakening or not.
Yeah.
That's part of it. But what the megatrends really is getting at is these forces that really drive the inflation, that drive growth, and hence stock earnings.
Yeah.
No economist is going to debate that technology is important, but also deficits and borrowing costs. We got globalization and demographic factors such as immigration. Those are driving the business cycle. I'm talking GDP. I'm talking stock S&P 500 returns. They explain half of the variance from like month to month. I'm thinking this is a long-term issue. Right. I'll worry about it in year 2035 when I'm retired, Josh. Hopefully I'm retired by then. But I'm like, no, this is actually mattering much more in the near term than people think.
Okay. One of the points you make is that the consensus forecast for growth going forward is that it'll look just like it just looked.
Yeah.
So that's like the consensus view, and you have it as kind of like a bell curve, but effectively, most of the forecasters are clustered around 1.5 to 2% growth, and then 2 to 2.5. Yeah, and of course there are some outliers, but you don't think it's going to be that simple. Why is that?
And again, I was in that camp.
Yeah,
I've been there for 2 or 3 years. If you had asked me what's growth for the U.S. the next 3 or 4 years, 2%. Why?
Well, it's the easiest thing to do is extrapolate.
And so I'm not disrespecting it. I was part of that issue. It's called what I call the status quo. Like it's not going to change. The question is, where do you see the risk? And it's only when you start thinking about the interplay, like a living, breathing organism. Think of how debt can change the interest rate in the bond market and inflation. Think of how technology, which has not driven growth for 25 years materially since the computer and internet, does that have the prospect for doing it? Now you can see if you can start interacting these forces, you can start get a better handle of where the risks are shifting. And that's what was eye-opening to me. So we are unlikely to get the 2% growth.
Can we double click on something you just said? Yeah. One of the premises in your work is that we've been missing this next technological shift since the internet age started, which is now 30 years ago, the beginning at least.
That's the irony in today's economy.
We don't have another GPT.
And we talk about technology all around us. We're modeling 3 types of technological change. What I was shocked to find is that we don't have any of those new, that just called general purpose technology, not since the internet. Social media, you can maybe call, if you're stretched, a GPT. It's done zero to economic growth.
It's an offshoot of the internet.
Really, the internet and the computer, which lifted growth in the late 90s.
Okay.
So we have that, and we actually have a lack of automation in service-based economy. So those two forces are pushing down growth on a trend basis. And that is financial ramifications if we persist over the next 10 years.
You think AI has the potential to be bigger than the internet
Yes.
and computer age
Yes.
in terms of its impact on economic growth?
Economic growth, both through automation and in what I would call co-pilot. Some call co-pilot, right? So
Yeah.
augmenting you and create
Augmenting workers.
Augmenting workers. So
Okay.
tell me what I can do better, not
Okay.
just save me time. But we need both because we have an aging society. We're losing millions. We're at the peak of 65-year-olds. So that we are simulating what AI and other technologies will do next quarter, next year, and 5-10 years out, based upon today's signals. This is not magic, Josh, and this is not speculation. We are taking of what the companies are doing, the labor and investment they're doing. The beauty is we have 150 years of seeing when there was past flops in the pan and when there was the early emergence of electricity or the personal computer. And we're seeing similar signals as those early stages of electricity and personal computer.
So you're not saying that tech hasn't been important. What you're saying is the last general purpose technology wave is already 30 years aged.
It's
and we need
aged.
something to replace it.
It's like a movie sequel. I mean, it's a new movie, but it's just not as good as the original.
Right.
And so there's just diminishing returns.
Okay. All right. I think I could wrap my head around that.
Yeah,
As I was reading, I was like, wait, all the earnings growth is still coming from technology.
It's
Your
always
answer
there.
would be yes, but it's old technology.
But how do you get a lift? We're going to have a flat labor force like 10 years from now.
You're thinking more about the bigger picture, not just corporate earnings,
not
and stock
just corporate
prices.
earnings.
You're thinking about societal impact.
Societal impact, yeah.
Okay. All right. Got it. So talk to me about how that affects your outlook for the economy then. If the most probable case to you is that AI is going to be transformative enough to overcome the demographic headwinds and the deficit problems that we face, what does that mean for your outlook? And how do we translate that into how investors should think about the future?
I think that's really the key one, Josh, right? Tell me how I can...
and be very specific.
I will be as specific as possible. So one is from the U.S. equity market, at least from the tech perspective, is effectively saying with 100% certainty, AI is going to be the next thing. And we're going to get that high 3% growth, let's say, if consensus is 2.
GDP growth.
GDP growth,
Okay.
right? Low inflation will justify the higher multiples, we'll grow into it, and the market's not overvalued at all.
And that upside to the growth outlook is going to come in the form of productivity.
Productivity, new business opportunities, which happen to pass. It's not just efficiency play, and you're justifying the current multiples. My point being is the tech sector in the U.S. and the NASDAQ and those, they're pricing in effectively. That has already happened. I'm saying it's roughly a 60% probability that's going to happen, which is a pretty bold forecast on my part. So that's code word for saying that part of the market is stretched. Even if
the technology sector itself.
Even if you're the most bullish on AI as you could be. Put another way, you need to see earnings growth in the next 4 years to be stronger than electricity was unleashing through to the U.S. economy in the 1920s. Twice
to justify current multiples in technology.
And I am not bearish on tech, and I'm not bearish on AI. What I'm saying is the current price paid for that is it's a little bit stretched. Now, how do you navigate this path? Because I just told you, Josh, that there's AI we could drive up 3% growth, but if it doesn't accelerate in the next 4 years, we have a deficit problem with higher interest rates and lower growth, which is a more nasty mix. So how do you navigate that? And I will answer your question. There are a few investment strategies that actually do well in both those states, so you don't have to pick a side.
Okay, so your next highest probability case for the future.
It's what I call deficit dominating. AI just is delayed in its impact, or it's more marginal. It effectively says the ChatGPT that you're using or the Microsoft, that's as good as it gets. So I
don't think anyone believes that.
No, I don't believe it either, but the signals are still too weak to say that that's going to overcome millions of people retiring, and that we have structural deficits of 6% of GDP during peacetime. They're outrageously high levels.
Yeah.
So I'm not saying, we're saying more odds than not, we're going to overcome them, and we're going to have growth that's stronger than we've seen in 40 years.
Okay.
With disruption. But it better be that strong. And then if it's not, now we're in the world of risk management, because now you're talking about growth that's below expectations 5 years out, and you have an interest rate that's continued to rise with our deficit pressure. So what we saw in April with the trade, and we saw the bond yield and the bond vigilantes, we saw the weakness of the currency, that is a glimpse of my other scenario if AI doesn't prove out to be as transformative as we think.
Well, that's a very discouraging
It is. The stakes are high on this. I'm not
Yeah.
being sensational. I did not see this divide. I was not looking for this outcome.
There are two things that saved the stock market this April. The first was Trump walking back those nominal rates of tariffs. But the second was earnings season. And in April and May, we ended up getting some of the strongest tech earnings in the history of the stock market. And NVIDIA was last. So it was Microsoft, it was Meta, it was Broadcom, it was Oracle, it was everyone involved in this AI build out. So
it's
not only will it save the economy in your most probable case, it's already saved the stock market on multiple
occasions. And we're early. So, I mean, this is consistent. If AI is going to be that next electricity personal computer, you need to see the tech sector doing what it is doing.
Yeah.
We saw it before. It doesn't guarantee, my only point is it doesn't guarantee the outcome. We've seen investment cycles in the past. Now we look back and say, well, it wasn't as important. Biotech had this in the 60s. We had some flashes in the pan, and that's the only reason why my odds are below 100%, Josh. If we didn't have any of those false signals, but there's enough of them that it says it's not
so
yet.
When you're right, the tough part about being around for as long as you and I have is we all remember 3D printing. Like we have this
metaverse,
the metaverse. Like we have this.
You got to respect it. You got to respect it a little bit. But I tell you what, though, if you maybe you will want to get into then. Okay, what's the second half of the chessboard, though? If you are bullish on AI, because there's two phases to what I call a tech cycle from an investment standpoint, and they can last. These two phases combined last at least 10 years.
Is the second phase all of a sudden the S&P 493? All of the non-AI direct plays become beneficiaries and grow earnings faster?
You're really smart, Josh. Yeah, you beat me to the punch. But it's not criticizing. There's two reasons what happens. You actually want to invest outside of tech in the second half.
Yeah.
And that's because if this technology, whatever it is, I'll call it AI, if it's that transformational, what is it doing for you and I if we run a hospital? If I'm an energy company, how am I getting more efficient? What new products is it unlocking for me? What new drugs is it discovering for medical treatments? That's what needs to happen. That's what happened. The electricity powered the assembly line, which powered GM and Ford Motor Company. Without electricity, we don't have those companies.
You use an icon of an electric drill. To illustrate that in the paper. And I thought that was a really great way of just like wrapping your head around what does it mean to be augmented by a GPT wave. So people building is a really easy thing for everyone to imagine. Bringing power tools to a job site versus however we had been doing things for the 100,000 years prior, hitting objects with heavier objects. That instantly unlocks the workforce to be doing more at a higher level, which allows you to think more ambitiously and imaginatively about what else you can accomplish.
Well, there's going to be a lot of disruption in the labor market. I mean, we're showing 20% of occupations are going to see significant job loss in the next 7-10 years. We started doing this work a decade ago because we got some sense of, I was trying to get some sense, how important is AI going to be? And so it's not, yes, it's going to unlock these opportunities, but I'm not going to sugarcoat it. There's going to be co-piloting, but there's going to be some significant disruption.
Is the get out of jail free card the demographics themselves? We're going to have this. This wave of people leaving the labor force at the same time. That this transformative technology theoretically will create this disruption.
AI will come at the right time, given our commitments on the debt side. I mean, unless we're going to raise taxes or cut the entitlements. And I just care about the gap. I don't care about the politics. I'm talking about closing the gap. Over 7 or 10 years out, I'm not talking about tomorrow. But if the AI would come at the right time, again, the demographic headwinds that we face, and you think the U.S. is alone on this? You got Europe, and you think Europe, China, everyone else is small potatoes in terms of demographic headwinds relative to China.
Okay. You refer to this as a J curve. I want to quote you, and then you can react to it. Transformation recurs to a technological advance, a GPT, or again, general purpose technology that unleashes creative destruction on a massive scale throughout the economy. As GPT cascades across it, the economy is reorganized and a new ecosystem is built around harnessing the GPT's benefits. Think of all the people who have internet jobs now, which did not exist 25 years ago. During this period, there may be a dip in productivity, which is commonly referred to as the J curve, associated with the adaptation to the GPT. In short, humans and machines learn to reorganize themselves to produce at higher levels than before. Was the 1930s in part exacerbated by the fact that it was in the midst of that electricity J curve? Or is that too far of a leap
I think
to
that's
make?
too far. There was a lot of bad policy errors.
Understood.
Trade, the Fed,
Tariffs sound familiar.
tariffs. Yeah, sound familiar.
Okay.
Although the Fed really did it.
So
as
you
well.
don't think that conversion of a non-electricity to an electricity economy
I
was
wouldn't want
part
to
of it?
portray it that way. I think
Okay.
though, like how are we even simulating technology change? Why we're saying that AI could be very disruptive? Because by the way, every economic forecast that I've seen, and most central banks assume the debt levels we have on the negative side, Josh, and the AI, let's call it on the positive side, will somehow magically offset each other and balance out so that we'll get no change in the economic regime we've been in.
Right.
If you're skeptical of that view, now I'm questioning like a lot of consensus forecasts, a lot of respected institutions, Federal Reserve, IMF, CBO, which so these are powerful institutions. I
Where is
respect
the
them a lot.
danger of us getting that wrong? The deficits are much more substantial than we are projecting?
They are, yes, or part of the AI is overhyped, which is why we wanted to bring data-driven framework. This is not me on a bad day, I'm more pessimistic. On a good day, I'm more optimistic. We're trying to bring math to it, Josh, which is why it took us 2 years to collect all this data, and we want to be as scientific as we can.
Yeah.
And that's how we're simulating the effects of future of AI. We're looking at this J curve comes out of VC and venture capital.
Yeah.
If CEOs around the country right now are adding more labor than typically would be expected, that's one, and they're investing more, you said about the earnings, than typically would be expected. So you got labor going up and capital going up, yet the current ROI is low. Why would any CEO and CFO do that?
Because they're thinking 5 years, not
which
not
is why
1
you
year.
get why the J curve goes from negative to go positive. We pick up those signals, not magic, in real time. We go back 150 years, so you can anticipate the sand shifting on the underingredients of economic growth, because the technology leads economic growth by 3 to 5 years. New products in the lab, you know what I mean?
Yeah. Michael Batnick and I were looking at CapEx versus employee headcount for the largest U.S. tech companies. The only one not furiously adding CapEx relative to its employee headcount is Apple. All the rest are investing at a higher rate than they were during the original .com boom. And
that is the J curve in real time.
That's the J, right. That's the reverse of the J curve.
And this is out of just great theorists at MIT and elsewhere. We need to make up new theory. You can then project out when the S curve reverses. Now, the S curve is going now.
S curve is the adoption.
The adoption, right? So right now, there's two phases of the technology side. Think of it this way. There's the companies that produce the tech, and then there's that consume it. So right now, we're in the production phase, right? And which is great for AI tech. I'm not belittling any of that. It's amazing work. But at some point, we're gonna move into phase 2, and no one's talking about that investment opportunity. Phase 1 outperforms the tech. The tech sector always outperforms. It was the computer companies, it was the .coms, it was the tens, and it was called the roaring 20s. At some point, it shifts. It doesn't have to be a bubble, Josh. It shifts to the consumers. It's all like the value-based companies. Tell me how a financial institution, a Vanguard, a bank, is going to get more profitable from consuming this. How's your firm going to get more? How is a hospital going to triage patients more effectively?
So I think we're 6 months to a year away from a consensus among small business owners that AI is improving their profitability, enabling them to serve more customers, or doing all of the things that we hope it does. I don't think most small businesses could say that right now, but we see B2B uptake amongst larger publicly traded companies. And what I'm focused on now, I look at the stocks that are leading the market.
Yeah.
It's with a prism through which I look at stocks.
Yeah.
I'm finding companies like Viva Systems.
Yeah.
This is a healthcare software company that's been around forever. Yeah. All of a sudden, they look as though they will be the key implementer of AI for their healthcare industry customers. You are absolutely seeing that uptake in a major way when you view it through that prism. So I don't think it's reached me yet.
No, I know.
We're playing. We have all the tools. We're doing all the things.
That's what I'm seeing it from a macro perspective.
Yeah.
You have it from the investor's perspective.
Looking at it from companies that are not in the AI business and making chips, but implementing.
It has to happen if AI is going to be transformational.
That's right.
And on the defensive, if you think AI is hype, so let's say you're skeptical. Well, you're running for the 493 on the S&P to diversify and I'm not picking on the Mag 7. I'm truly not, because they're doing amazing things from an innovative standpoint. I'm thinking about second half of chessboard. Where are people not talking about the investment opportunities 3 years from now?
Yeah.
Because if we're talking, if we're talking about AI now, if I just woke up today, it's like too late. Too late, Joe.
Yeah.
Think about you think about the underperformance of small caps, the underperformance of non-US companies. You talk about US exceptionalism, it's all been driven by the top 7. And then also the value space, massive 100-year relative differentials. Now, I'm not saying all those sectors, all those areas I just mentioned, non-US equities, value-based companies or an ETF, and non-Mag 7 are all going to outperform in the future because they underperformed in the past.
This is the most interesting thing. Like the most out of consensus thing you could say is that from a stock investor's perspective, the biggest beneficiaries of the AI boom going forward will not be GPU and chip manufacturers like Amazon, Alphabet, NVIDIA, Broadcom, and will not be the cloud service monopolies, Amazon, Microsoft, Alphabet, but will instead be companies that have their profit margins expand by 500 basis points in the next 2 quarters because they're implementing
That's
AI.
where I'm at, Josh.
You could get a re-rating in small cap value. You could get a 20% re-rating with no change whatsoever
and
to
I'm saying
the
this is not
economy.
just simple mean reversion, which is a dangerous, you know that, Josh. So it's like, no, this is how economic growth and cycles work during transformational change.
Yeah.
It's got to unleash, it's got to spread, and we got to go from producing the tech. And I'm not saying those companies are going to crash and it's a bubble. We don't have to get into that debate. I don't have to drag Bob Schiller in here from, we're going to have that debate. You don't need to answer that question. All I'm saying is what the next phase is, and that is the phase and you don't have to pick sides, because if AI is a dud, like social media, we all use it, but doesn't really lift growth. Okay, well, the Mag 7 is going to come back down to earth.
Well, I think the physical AI is really going to be the thing.
But I think you're on to something. It's like, tell me how, and I think we have a little time on this. I don't see it like in the next 6 months, but there's going to be a consciousness that's consistent with other market cycles. And I at least didn't see this until we got into this work. You see with electricity, you see with the combustion engine, and I'm not telling history just for nice stories. I'm talking about from an investment standpoint. What do we talk about the next 4 or 5 years? It's actually pretty exciting. And I think that's good for the durability of the equity market because it's so concentrated right now in more of a handful of sectors. I think it would be healthier. And that's, I think, for your listeners just to consider, like, what's the next opportunity set? Knowing the Mag 7 have done fantastically.
The Mag 7 were a much bigger proportion of the S&P 500 in February during the last high versus now. So now the S&P has broken through to a new high, but the Mag 7 as a percentage have declined in importance. They're still gigantic. They're still dominant, but we are seeing an S&P that's less concentrated this time,
and I think it's than
it was 4 months ago.
I think it's a really good development. If I had to pick one of the market indicators to continue to be looking at, is that share that you just mentioned, Josh, going down in an up market. That means this J curve is spreading. Yeah. And that this is not 6-month cycles. These things that you don't have to be obsessed every single day to watch the news. You can think, oh, this is a 4 or 5 years. It's a trend. Okay. That can be at a tailwind, and you don't have to be cute trying to time it.
But I think the answer that we're giving people, why, if this is the era of AI, aren't I making a mistake sitting around in mid-cap value, small cap, bank stocks, other companies that are not playing in AI? And the answer, hopefully, is no, because you own the beneficiaries. Yes. The Mag 7 have nothing but CapEx bills in front of them for as far as the eye can see. Yeah.
And they're going to lower the cost. The cost of technology is going to come radically down. I think people on the tech side, they just underestimate. There's some stars that emerge. You know this, Josh, but they underestimate new entrants.
I want to talk about one of the other megatrends, which is inflation.
Oh, and
one of the things that I think you do really well is debunk a lot of false perceptions that people have. Yeah. And one of the biggest ones is that we had this era of globalization, specifically the entry of China into the WTO, which had this like massive impact on keeping inflation subdued because they were exporting deflation effectively from China to our shores. Yeah. And that's what kept inflation in check. And now the result of the trade war is that inflation is going to be with us in a major way because we no longer have cheap goods coming from overseas. Sure. You sort of say the China shock, while noticeable in the data, is not as pronounced as people think in terms of keeping prices low. Yes. Therefore, may not be that important going forward. if we have this bifurcation of the two
Well, it's
economies.
a good summary, Josh. I mean, again, all we're trying to do is quantify these issues in a complex system. And the key insight is that we're allowing all the other factors in a horse race to hit inflation too, because it's not just globalization that can drive prices up and down. You got technology that can move stuff. How about the Fed? We got deficits that can lead to higher inflation. So we're letting the data speak. And what I found is globalization. Yes, the more we globalize, which means the more we trade and have more imports and exports coming into the U.S., yeah, you have cheaper goods. It's comparative advantage. But it's been 22 basis points, so 0.2% of inflation with the acceleration of globalization over the past 25 years. In other words, we would have had an inflation of 2.2% rather than 2.0%. If that sounds like a small difference, then bingo. Globalization hasn't affected inflation. That's important because some people are out there saying, we're in a deglobalizing world. Ergo, which I'm not cheering for, by the way, ergo, we're going to have a high inflation future. And, you hear it and it's like, what do you mean? 6, 7, 8%?
I would ask the question differently.
Yeah.
I would argue if the China shock was not really that big of a shock and did not give us as much disinflation as people think it did, probably it was more damaging from a societal standpoint. Politically, maybe it would have been better if it never happened. And Trump is right. And we should.
Here we go.
I'm asking the question because it's a logical conclusion.
Well, no, I don't talk about some of the paper, but I started talking about in the book. And listen, there's definitely when you find that when you globalize more, open up your markets, your own domestic investment rate goes down.
And that's what happened this time. And that's what happened this time.
And I found that we find 150 years it's been happening, and you boost the profitability at the same time. Yeah. So are there signs of a little bit higher income inequality? Lower domestic investment, which could have had the manufacturing sector, the middle class. Yeah, it's in the data. And there's not, I mean, from my perspective, as a macroeconomist, there's not a debate to that. The whole question, this is like not just that open-ended question, Josh. I would just rephrase a little bit to say, well, like, what's the alternative and what other policy measures are we talking about from globalization? You do not want to, what's going to happen is you don't want to just cut off your borders. I think it is like, where are those pockets of production? Where are they going to move? And most economists, myself included, have done a poor job. Like everyone says, economists, we believe in free trade. Yeah, but there's an asterisk there. It's a level playing field. Yeah. It has not been level. There's been abuses made across multiple countries for 100 years, by the way. And so I think we do have to account for it. And some of that is coming up in the current dialogue.
These are all trade-offs.
They're all trade-offs.
And the idea that one is right, the other is wrong is not true.
No.
Okay.
No. So you don't want to push people in. Like I always worry about what's called corner solutions. You know what I mean? Like it's all right or all wrong. It's like this is a complex web, but I'm not going to back away. Yes, there are trade-offs. Like
I think what most rational people would say at this point is, yes, there were trade-offs.
Yeah.
We can now look back and study them.
Yeah.
And the reality is that in some cases the pendulum went too far, where we got too little benefit for giving up way too much.
Or you got concentrated gains versus spread out losses that a lot of people see. I think that's the other thing.
Yeah, I would agree with that. Let's talk about demographics. You find this to be important, but not as important as the people who have made a career of studying demographics seem to say. When I say important, I mean the impact on inflation, on the economy, on the stock market. So what's the Vanguard house view based on this research about the impact of demography, and where do we stand from a demographic standpoint?
Well, there's that old phrase, demographics is destiny, which means it determines your fate for growth, inflation.
But it doesn't.
It doesn't. It's actually not. It's just
so
not
nobody
true.
should say that anymore.
It's not true.
Okay.
And so I'm going against a lot of studies who have looked at some of these issues in isolation. When you put them all up against each other, I'll think of inflation. People say, fewer people. Oh, so we're going to have high inflation because we have fewer workers.
Right.
Simple Econ 101 would tell you, Josh, if you have one fewer worker, you'll probably also have one less consumer.
That's right.
Supply and demand moves in that way. Prices are unaffected.
Right.
So this is actually Econ 101, but it's become this narrative. I mean, I even heard the Federal Reserve talking about, we have lower neutral interest rates because of demographic dividend. It's amazing how the R-star and all these neutral rates have risen, yet the demographics haven't changed the past 10 years.
I would say I've seen more people have wrong-headed ideas about investing as a result of demographics than maybe any other source.
I know. I don't know why that is.
Well, I think they look at Japan.
Yes.
And I think they see this kind of sclerotic generation of less and less younger people, and they match it up against this like endless disinflationary, deflationary cycle, and they say these two things explain each other. Therefore, if we find other countries with this demographic problem, the returns in the stock market will be weak.
And I tell you, listen, if you have a slowing population growth or even goes negative, like parts of Europe are, right, or parts of Asia, listen, I'm not cheering for poor demographics. It's a part of growth. Like GDP growth at the end of the day, which is like earnings growth, loosely, GDP growth is equal to number of people changing plus the technology. But it's that last one, Josh, we were just talking about. 97% of the ups and downs of GDP growth over a 5-year base, 97% are correlated with technology. Effectively zero correlation with demographics. So yeah, we want skilled immigration. Yes, we want also equal higher population growth. You have a little bit higher economic growth, but there's no correlation in the investment outcomes we care about.
Right.
And actually, it's never been true. And in fact, here I'll give you a little factoid. Some of the greatest periods of technological, just acceleration were periods when demographics were worsening. I'll give you 4. The Renaissance.
I was going to say, let's start with coming out of the bubonic plague.
The bubonic plague, the Renaissance, the Industrial Revolution, the Roaring 1920s. And if AI is correct, we're going to have another one added to the list.
When you say weakening demographics, you mean a larger portion of aging people?
You both. I mean, we look at both dimensions. It's either aging of society, like the percentage of. It's not. I mean, to be blunt, the mankind's been aging since we've been on planet Earth.
I'll give you a concurrent example. A lot of headlines last year about the South Korean population going negative.
Yep.
Effectively, young single people are just not marrying each other and starting families. There are a lot of societal, cultural reasons for that. We're not going to get into today. The Kospi is up 30% year to date this year, and the I think it's called the 2550 index, which is like their NASDAQ, is up 42%.
Yeah.
There's absolutely no correlation whatsoever between South Korea's demographic problem and the returns of their stock market, the profitability of their companies.
I know.
It's just not.
It's just not there. And again, all equal, you're going to lower GDP growth or raise it a month, but all the big moves up and down are around the technology side. The only time that demographics become an issue, and that's hence my deficits dominate scenario, Josh, is if you tie the aging of society to your debt burdens.
Which we are doing.
We are doing. And so again, I'm not saying it can't matter, but it's going to be now through debt and deficits, not because we have an aging society per se.
Yeah. Okay. Let's do another myth bust. Inflation is entirely monetary phenomenon. Rising fiscal deficits don't matter. That's a common perception right now. What's wrong with it?
Well, it's just that what I find and what we find, and there's some academics who wouldn't disagree with my statement, and that is, if deficits, the gap between revenues and tax revenues and spending, if they're chronic, so they're not just because of COVID or because the global financial crisis and, deficits blow out.
A deficit every year forever.
Yeah, it's just every year forever. It just keeps rolling over. You can start to raise inflation expectations. John Cochran at Chicago talks about this. It's called the fiscal theory of the price level. We weren't looking for it, but we find modest evidence of it. Now, it's small in the United States right now, but remember, we're attributing underneath the surface. We have this is like a sonar radar system. We can see what's driving inflation, not just the cyclical stuff, but these forces. And it's starting to modestly put up inflation. It started during COVID. The last time we saw this was in the 60s and 70s when we started to have the rise of inflation and hence interest rates. So I'm not saying that the 70s is coming. What I'm saying, though, is you can have high deficits that people, and why does inflation expectations start to go up? It's because you and I start to think, you know what? Congress is never going to raise taxes or rein in spending. Now you start to see pressure in the U.S. currency, and you have some out there talking about the potential of a fiscal crisis. I think some of those are overblown, but that dynamic is why fiscal deficits can matter for inflation.
This is when you hear the Fed say things like inflation expectations are well anchored.
Well, they was well anchored. And again, the Federal Reserve has them, but that doesn't mean that they're omnipotent. Now, those that want to paint a fiscal crisis picture, and they're out there, there's a probability. In fact, we've quantified it in the book. It's 5%. That literally the U.S. currency goes through massive depreciation. We have a really spiking interest rates because of our debt levels, high inflation. It sounds like an emerging market. Why they're not that high and not higher is because you have the Federal Reserve, to your point, Josh, where I'm going. The Federal Reserve is going to try to fight this, whether the inflation is from COVID and supply chain or it's Congress continuing to print money from a deficit side. So, but that's, I think, thematically what we're going to see. I think we're living it a little bit this year. We're going to pass potentially another fiscal package.
Yeah.
Deficit's going to go up. Yeah, you have the Federal Reserve on hold for longer.
Yeah.
Cutting. That's a little bit of a little
and
tension
now
there.
specifically saying they're on hold because of developments on the fiscal
And there's
side.
tension. You see the headlines. There's tension. That, I think, is one of the thematics here. You can navigate it. That's the deficit world that we could be in.
The last thing I want to tackle from the paper is this idea: as America ages, U.S. debt is projected to set record highs. You have a chart in here, and we'll add it. But effectively, you're showing these spikes in U.S. debt throughout history, and you're showing the one that's coming soon, 2024 to 2054. The next 30 years.
Yeah.
And according to the CBO forecast, that would land us at about 171% debt to GDP.
Yeah.
Okay.
Which is not good.
Not good. Is there any way out?
Yes, there is a way out.
Does it rely on Democrats and Republicans agreeing to something?
Which may not leave you in a great deal of confidence.
Okay.
That's why you'd hedge your bets a little bit invest outside the U.S. And I'm not joking.
That's
always been a core.
Compromise is the way out, or
no?
We're not outgrowing that.
No, you can get a little bit on the growth side. You can buy time.
Okay.
And when I talk about, whether or not we'll get the political sort of meeting in the middle, I don't know. That's why I think, you could see a little bit of pressure in the bond market. Not tomorrow. This is probably 2028 issue. Not to put a timestamp on it, Josh. I'm not complacent on it. It's just, the bond. If the bond market, applies a little bit of pressure, that's where you start to see some of the interest rate pressures. Not tomorrow.
Yeah.
We generate scenarios where the 10-year Treasury yield is 6 or 7%, not 4.5. This is not for tomorrow.
Yeah,
and I don't mean for people to be scared of their fixed income investments. The irony is, if you're in this world and AI doesn't sort of unleash growth,
you're going to see a lot of demand for bonds.
A lot of demand,
right?
You got real rate of inflation of 4 or 5%.
It'll counter itself. Well, it's an awesome paper because you did something that I see a lot of people have opinions. Not many people have opinions, and they can say, but this is what the data said, and this is why this is my opinion on the drivers of all of these things. So I want to congratulate you on that. Before we let you go, let's talk about the book. So it's called Coming Into View. Yeah. Very clever cover. I like what you guys did there. And the subheader is How AI and Other Megatrends Will Shape Your Investments. What's the premise of why it's a book and what people... Very tough to write about AI in book form, I would point out.
Totally.
Because
we had AI write the book.
Because it moves very quickly. The technology moves very quickly. So.
Well, actually, it's what we were just talking about, though, Josh. We took the paper and the eye-opening results of the economic diagnosis and the investment opportunities. Only reason why we felt compelled to write the book and to write it for a broader audience. The paper you mentioned, again, Josh, you have and your listeners have a deep investment background. Well, what if I'm just reading the Wall Street Journal a little bit? I'm watching my 401k.
Typical person at an airport sees this and says, I love books like that.
So if I sound like an economist in that book, people can take that book and smack me in the head with it.
Yeah.
Because I tried hard to take those papers and just put in digestible form. I don't want to read all these white papers. Just tell me demographics, does it matter or not? And we use some stories.
People like the story.
So we use that as some stories. Deglobalization, is it? And I say, no, it's a fallacy. We're not deglobalizing. Not in the dimensions that matter most.
Yeah.
So but we're just all the data framework you talked about in the paper, that's the same empirical engine we're using behind the book. And we talk about portfolios that investors could think about.
Yeah.
And I channel Jack Bogle. You saw end where we started. You talk about 50-year anniversary and so forth. And I'd be remiss as a Vanguard employee not representing Jack. So in fact, I lead the group responsible for thought leadership. We have over 100 people now. It probably takes 100 people to fill Jack Bogle's shoes.
Wow.
I think we only got one shoe, but it's just people, for someone who don't want to go on all the technicals, but the heft is behind in the paper.
So the book concludes with a couple of chapters, and this is I love when books do this. It's okay, I just gave you a lot of information. Now what do you do with it?
What do you do with it?
So the last two chapters, chapter 9, A Victor's Portfolio, Act 1, Divide and Conquer. Chapter 10, A Victor's Portfolio, Act 2, Choose Wisely. Without ruining the end and telling us who dies or spoiling, like, what is the investor walking away from the book having learned?
Well, I think you're saying, listen, the future is not going to be the recent past, but here's an investment portfolio where you don't have to be heroically smart and pick sides.
Yeah.
Can you hedge regardless of which path unfolds? Because it's going to be an optimistic or pessimistic one, and you don't have to bet the ranch on it. And so this is around diversification and risk management, Josh, and some of the things we talked about today on the equity, on the stock side. It's not all tech, even though it feels like it now. And on the fixed income side, could be a source of ballast, despite the concerns of deficits I mentioned today. And I talk a little bit about the role of active management for those, from Vanguard. The role of active in a low-cost way to amplify some of the risk mitigation you want to think about.
Okay.
So there's opportunities ahead. It's not just mitigating the risk. There's opportunities emerging that are not apparent right now, and I'm glad that you talked about some of them today.
Now, who will play you in the Netflix movie version of Coming Into View?
Oh my goodness, The Economist! I'm just happy I have a job.
Can I give you? I got one for you. Guy Pearce. You know the actor Guy Pearce?
Oh yeah,
terrific actor. You got a little facial structure.
Oh, I don't know.
I feel like that works. I don't know who's going to play me. Listen, I'm excited. I'm going to read this summer.
Thanks,
and
Josh.
I want to tell people they can get Coming Into View on Amazon, Barnes & Noble, wherever fine books are sold, the airport. So I find most people buy my book in the airport. So,
no, I enjoy it.
All right, this is awesome. Any parting words for the audience of investors, advisors, people that follow your work? What do you really want to land on them as a result of this?
Well, again, I think start thinking about living in a deeper AI world and what's the next investment opportunity.
That's awesome. Joe Davis, thank you so much. And where can people follow your work other than buying the book?
LinkedIn, and
you're big on LinkedIn, I know.
And you guys, right? You're talking to all the smart investment folk out there.
Absolutely. All right, Joe, thank you so much for doing this. We appreciate it. Thanks to all of you for watching, listening. We'll see you soon.